Good morning. This is Bloomberg Daybreak Europe. Happy Friday. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks fall as worries over credit send a gauge of US regional banks plunging more than 6%. The fears outweighing news of tariff relief for the country's autos industry. Meanwhile, the US president is set to host Ukraine's Volodymyr Zelenskiy after announcing a second meeting with Vladimir Putin, taking place within the next fortnight. Plus, BBVA's bid gets the thumbs down. The Spanish bank tie-up with Sabadell is off after shareholders say no. Bloomberg has the first interview with the BBVA chairman later this morning. So it is risk off across these global equity markets as concerns about cracks in the credit space in the US start to filter through into the banking space, at least when it comes to some of those small and regional lenders. And you saw the impact on that yesterday, and that is sending shockwaves through the equity space. European futures then pointing lower by 0.9%. Here in the UK, the FTSE 100 looking to drop 1% so far as we build up to the Friday open. S&P E-minis pointing lower by 0.5% after the losses of yesterday. So US equities looking to build on the downside that came through by the end of the close yesterday, and again largely tied to concerns about credit and about some of those regional banks. Nasdaq 100 futures pointing lower by 125 points despite the optimism coming through from the likes of TSMC and ASML earlier this week around the AI theme. The Nasdaq 100 is currently lower, pointing lower by 0.5%. European stocks actually performed quite well yesterday, but there's a bit of a catch-up as a result of what happened overnight on Wall Street. The 10-year is below 4%. It's the first time we've seen that for a long time. The 2-year as well is down about 25 basis points in the last 30 days. So Treasuries remain well bid in this risk-off environment. 394 on the 10-year, yields down 3 basis points in the session today. The euro at 117 as the dollar is set for its worst week since July. The selling of the greenback is back in focus. The euro benefiting up 0.2 in the session today at 117. Brent at $60 a barrel, set for its 3 straight weeks of declines for oil prices on concerns about oversupply and, of course, US-China tensions as well. Down again 0.3% in the session today. Gold, the bid remains there for this safe haven at 4,366. We are closing in on the best week for the yellow metal since 2008. The gains today up 0.9%. In fact, I'm being told by our very on-alert producer that we have passed that mark. So we are now set for the best week for gold since 2008, closing in on 4,400. Let's cross over right now to Winnie Su, standing by in Hong Kong for a check in the Asian markets. And the sell-off is there as well. Winnie.
Yeah, morning, Tom. It seems like a similar picture here in Asia today. The mood here is that flight to safety as we see that Asian stocks also down about 0.8% here. And that's really tracking that concerns of the U.S. credit risks there. And we are also seeing that financial stocks here is that major drag. And that's also following that big sell-off in the U.S. banks overnight. Now, similarly, we are seeing that Asian bonds are rising, tracking those gains in Treasuries as we are seeing that investors are preferring less risky assets right now, just given how the macro environment is. Now, we take a look at what's going on in Hong Kong because Hong Kong stocks are actually the worst performers in the region today. And that is that still ongoing concerns around the U.S.-China tensions. Even Morgan Stanley saying that they right now do not recommend a risk-on approach. So we are, yes, seeing investors taking some profit after this recent strong rally in the Chinese stocks, and also repositioning ahead of the fourth plenum that we are expecting next week, where we are going to see government officials discuss about that 5-year plan and to see how much of a domestic stimulus they are going to roll out. Now, what's going on in Japan here is kind of a similar story, but a little bit of a twist here because we are still seeing, yes, stocks down on that global concern, but also the domestic political uncertainty. And yen here is gaining a little bit because of that demand for haven assets, but also Bank of Japan saying that they are still keeping doors open when it comes to the near-term rate hikes from the central bank. And right now we are waiting for Takaichi to potentially form that coalition with Ishin, which is the Osaka-based opposition party, and waiting for that potential vote for the next prime minister for Japan next week.
OK, so those coalition conversations continue in the balance at the moment. As you say, the yen up on those comments from the BOJ. Winnie Su, thank you very much indeed. Joining us out of Hong Kong, of course. So European and US futures are lower on concerns about the state of the US credit market. Let's get the details from Bloomberg's Valerie Teitel, who's been watching this and probably up late into the night on all the action stateside. Val, some big moves yesterday, some real spotlight right now on the credit space, but also those regional banks.
Yeah, it was really a down to a write-down that was disclosed by Zions Bancorp in the session yesterday. A $50 million write-down on loans related to funds having to do with distressed commercial assets. So Zions disclosed that write-down of $50 million, and then we heard from Western Alliance that they also had given loans to the same counterpart. So those shares also sank in the session yesterday. It dragged the wider banking industry down by 3.6% if you look at the KBW Bank Index. And Tom, there were just some slight hints of some funding stress in the market. If you take a look at the SOFR rate, the overnight lending rate, even the repo window of the Fed funds, it did seem like there were some extra borrowers in the market yesterday. And that really led to the front end performing decently well in the session yesterday as the market perhaps prepares for the fact that we could have a more aggressive Fed on our hands. The two-year yield, Tom, is now sunk 20 basis points since last Friday, since that first Trump tweet reminding us that the trade war with China is still on. So it really has been a breakout when it comes to fixed income, especially in the front end. There are some hints that traders out there are positioning in options for a boosted 50 basis point rate cut between now and year end. So definitely one to watch how the front end trades this morning. We are lower in yield. I also want to mention what's been going on in the equity market. Obviously, it's jolted risk sentiment. We're now eyeing close to the lows on Friday than we are from breaking back up top. So S&P futures on the back foot. I do want to note, Tom, that the tech trade did feel impervious to this yesterday. NVIDIA was still the biggest points gainer on the NASDAQ yesterday. It gained over 1%. So it does seem like perhaps that the AI trade is not being as jolted by what's going on in the credit space.
Yeah, and we'll see if the earnings story confirms that, of course, in the days and weeks ahead. Bloomberg's Valerie Teitel, thank you very much indeed. Meanwhile, the White House is poised to deliver a major win for automakers, easing tariffs after months of lobbying by Ford and GM. The Commerce Department is expected to announce a 5-year extension of an arrangement that allows car makers to reduce duties on imported parts, which is a key offset that could come in as early as today. Joining me now is Bloomberg's news desk editor, Balazs Pence. Balazs, talk us through the rationale then. We've seen, obviously, this pretty aggressive lobbying, as we mentioned, from the likes of Ford and GM. It seems the Trump administration is taking this on board. Why are they rolling back this element of the auto tariffs?
Well, Tom, the auto industry has been among the hardest hit in this trade war, in the whole tariff rollout. They have to contend with not just higher tariffs for the cars they make outside the U.S. when they ship them for domestic consumers, but they also have higher input costs when it comes to materials like steel and auto parts. So as you said, there has been intense lobbying by the industry. And one of the points that these executives have made is that after the trade agreements, those country-by-country deals that the Trump administration has achieved, some of their competitors, for example, in Japan, can actually be more competitive on the U.S. market because of their lower cost base, because of their currency differences. So this just goes to show how complex the entire trade landscape is now, as the administration tries to push different buttons, and how they have to balance out sometimes competing priorities when it comes to trade.
OK, so some tariff adjustments around the auto industry, which is beneficial there, and also some changes when it comes to some of the drug makers. At least one of the key German names, Merck, striking a deal with the Trump administration to reduce the tariffs on its imports into the US market if they reduce prices on fertility medicines. What do we take from this? Is this a reminder that, in fact, the threat of tariffs, the use of tariffs from the Trump administration is actually working to some extent to get the kind of outcomes they're looking for?
Well, it certainly does seem to be the case when it comes to the pharma industry, which is one of the sectors that we have been watching very, very closely when it comes to their exposure to tariffs and trade. If you remember, a couple of weeks ago, there was a similar agreement with Pfizer around their prices and their tariff exposure. And there was a big rally in industry stocks at the time because the assumption was that that might be a blueprint for other companies as well. And that is something that we are seeing happening now in the Merck case. Now, we should mention also that fertility and IVF in particular has been one of the big campaign issues for Trump while he was campaigning for his presidency. And this is something that the White House has pushed quite aggressively with different measures, different executive orders that they're trying to really put their stamp on this. So it fits into both baskets, if you will, both in terms of how tariffs work and the political priorities for the White House.
Bloomberg's news desk editor, Balash Pence, thank you very much indeed on some of the adjustments around the tariff regime in the US. Here's what else to think about today, this Friday, then at 10 a.m. UK time, looking at Euro area final CPI, so a fresh touch on the inflation story, of course, out of Europe, where they have successfully, the ECB got it down to around that 2% level. So we'll get some more detail on that. And at 10:35 a.m., so shortly after that, we're going to hear from the BOE's Hugh Pill, speaking at a time, of course, when we've seen a real bid, actually, for UK gilts. We lead up, of course, to the November budget, but expectations now adjusting. Maybe the view that the BOE can go further than some had thought in terms of additional rate cuts. That debate remains live, of course, so interesting to hear from him at 10:35. And at 5:15 p.m. UK time, staying on central banks, the Fed's Musalem is going to be sitting down with Bloomberg's Mike McKee for a fireside chat. This after we heard, of course, from at least one Fed member that there's a view that you can still go further on 25 basis points, of course, and Stephen Myron suggesting that he is still pushing for 50 basis points. So we'll get another view on the Fed later today. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to Dayby Go on the terminal. And that meeting, potential meeting, second, of course, of his second term between President Trump and Putin is front and centre in terms of the Daybreak story. Coming up, talking of that, 2 weeks. That is apparently the deadline US President Donald Trump has set. He likes the 2-week deadline, doesn't he? In terms of another meeting with his Russian counterpart to discuss ending the war in Ukraine. We'll bring you the details on that. They had a lengthy phone call yesterday. Stay with us. This is Bloomberg.
Earnings season is here.
European earnings in focus. We'll break down the results.
Bloomberg is first to break the numbers.
And we bring you some earnings that are coming through a Nordea Bank.
LVMH reporting a surprising return.
And BP.
The earnings story, I think, is really fascinating.
There's just so much news. With the smartest insights.
It has been a record half-year result. We are committed to capital return. We were even able to increase our outlook. It's very good news, I think, for our shareholders.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now some other stories making the news this Friday. Bloomberg has learned that Meta is close to finalising an almost $30 billion package to finance its data centre site in Louisiana. The deal with Blue Owl Capital would be the largest private capital deal on record. Sources tell us that Blue Owl and Meta will split ownership of the Hyperion data centre site, with Meta retaining just 20% of it. And EssilorLuxottica has posted revenue that beat estimates in the third quarter, lifted by its AI glasses partnership with Meta. The world's largest eyewear group got a boost from sales of wearable technology, which posted, quote, exponential growth. Total sales increased 11.7% at constant exchange rates, well ahead of estimates for 8.5%. And the head of the IMF has urged countries to be calm as they navigate US tariffs and a changing trade environment. Kristalina Georgeieva spoke to Bloomberg's Lisa Abranovich on the sidelines of the IMF and World Bank meetings in Washington.
If these recipients of Chinese goods feel the heat and decide that they too should impose tariffs, we may still have the risk of a trade war moving from one place to another. So our message to everybody is be calm, and to China, be careful. Do not provoke other countries to see you as a threat to their economies.
Okay, well, a message there to China from the head of the World Bank, of course. Meanwhile, John Bolton has been charged with allegedly mishandling classified materials. Bolton served as President Trump's national security advisor during his first term, but went on to become one of his fiercest critics. He's previously denied mishandling classified information. And Chancellor Rachel Reeves says she will look at regulated prices in her UK budget next month as part of efforts to bring down inflation, a sign the government is considering action to help reduce energy bills. Speaking on the sidelines of the IMF meetings in Washington, she also hinted that a bank tax wasn't on the agenda, saying she recognised levies on the sector are already high. Reeves faces a difficult budget, to say the least, next month as she looks to close a budget gap. And Bloomberg's Lisa Abramovich will be speaking to the UK Chancellor at the IMF meetings in Washington at 5:40 p.m. London time. So tune in for that conversation. Let's get the latest in terms of the banking space in Spain right now. BBVA and Sabadell, we have an update. Kriti Gupta has been watching this very closely from the outset and will be bringing us a great interview as well later in our programming hours. What's been going on? BBVA looking to take over Sabadell. Is that now dead in the water? What's happened?
It's dead in the water. A 17 billion euro deal, which started out about 17 months ago at 14 billion euros. Carlos Torres Vila and the team over at BBVA have thrown the kitchen sink at this deal, really trying to pull down some of their exposure, their emerging market exposure. They get most of their revenue from the likes of Mexico, Turkey, part of the United States, and other parts of the world, facing a lot of political pressure from the Spanish government to have more exposure to Spain. Here comes Sabadell, perhaps the answer to that, a relatively less integrated bank, a shareholder base that has inherited and used those services for generations. BBVA thought a 17 billion euro takeover bid, an all-stock transaction, would be enough to, one, fix their exposure problem, and two, help integrate Sabadell into some of the new technological infrastructure that the banking universe is seeing. That being said, they needed to hit a 50% shareholder tender offer. They had the legal ability to bring that buffer down to 30%. A lot of people thought they would. Turns out they weren't even able to get that. The mixture of their retail and institutional investor base that had chosen to take on that offer really only went to about 25.5%, to the point that BBVA announced yesterday that they are pulling back from the offer. They thank everyone for their hard work on this, but it's just one more piece of this equation that banking consolidation is not in the future for Europe. We're going to have an interview, like I said, with the chairman himself, talk about what the future of BBVA actually looks like and the future of the banking.
But that's really key to this, isn't it? BBVA, Sabadell, if there had been that merger between the two, this would have been one of Spain's biggest banks, right? It would have gone toe-to-toe with Santander. And to your point, this is something that so many people have called for, is banking consolidation. And time again, we're saying that it is not able to get over, whether it's national preferences or regulatory hurdles. This is a problem, is it not, for Europe? Where does this leave banking? Am I overreading it? Where does it leave the consolidation story?
I don't think you could overread it enough. There are so many pieces to the equation. You have a consumer lending piece of it. To your point, if this consolidation story had actually happened and BBVA was able to take over Sabadell, which we should point out, the government of Spain, Carlos Cuerpo, came on our very own programming to highlight the fact that even if there was that takeover offer, they couldn't integrate for 3 to 5 years. So this has become a political story as much as a business one. That being said, if that combined entity were to take place, it would have been a major competitor right on the heels of Santander in terms of size, in terms of domestic assets, overtaking Caixa, which is the largest domestic bank in Spain as well. There's concerns from the Bank of Spain on what it means in terms of kind of moving the lending rates that are available to everyday Spanish citizens. There's concerns from the government in terms of their international exposure. You name it, there's been a roadblock here. But to your point, the read-through across Europe is so crucial because it's been happening at the same time that the conversation conversation over in Italy has been taking place. UniCredit, Andrea Orcel trying to make the bid over for Commerzbank and a series of other domestic banks as well, and finding roadblocks across the way, even though a bigger, stronger banking sector is what a lot of people have attributed as a first step towards a capital markets union and integrated European financial market. This doesn't seem to even get us any closer. If anything, it takes us even further away from that reality.
Pretty good. So excellent reporting. Thank you very much indeed. Anchor, of course, of Opening Trade, who will be bringing us first a conversation with BBVA's chair, Carlos Torres Vila, at 7 a.m. London time. So stay tuned for that crucial interview. Now to the earnings story. Volvo Truck coming through with a third quarter set of numbers that meets estimates. Operating profit coming in at 12.5 billion Swedish krona. The estimates have been for 12.3, so just slightly above that in terms of third quarter operating profit. In terms of net sales, you're looking at a number that is in line with estimates in the third quarter, 110.7 billion Swedish krona. The margin coming in slightly higher in the third quarter. Adjusted operating margin at 10.6%. The estimates have been for 10.3%. So top line is that essentially sales meeting estimates, the margin slightly better, and the profit slightly above for the third quarter for Volvo Trucks. A stock to watch at the open. There's a lot more coming up. We're going to get the details in terms of this potential meeting between Presidents Trump and Putin, the second, of course, of President Trump's second term. What it means, of course, for the fate of Ukraine. That's coming up. This is Bloomberg. US President Donald Trump says he plans a second meeting with Russian President Vladimir Putin within 2 weeks. He's due to meet Ukraine's Volodymyr Zelenskiy later today.
I thought it was a very good phone call. I thought very productive. But I'll be meeting with President Putin, and we'll make a determination. Tomorrow I'm meeting with President Zelenskiy, and I'll be telling him about the call. We're going to be meeting in Hungary. Viktor Orban is going to be hosting. And it's really something that's time. Last week, over 7,000 people were killed. That's ridiculous.
Well, for more, we're joined by Bloomberg's Tony Halpin. Tony, what do you make of these developments?
Well, it's become something of a meme that at moments of hard decision-making for Trump in relation to pressuring Putin on the war, that the Kremlin intervenes, Putin intervenes, and there's a deadline pushed back to 2 weeks. We've got a summit now announced for 2 weeks or so, just on the eve of Trump meeting Zelensky. One key issue at that meeting today is whether the US is willing to provide Tomahawk missiles to help Ukraine fight back against Russia. That's clearly something the Kremlin was unhappy about. It was discussed on the call yesterday, and it was notable, I think, that Trump began to row back from those comments and talk about the fact that the US also needed to keep its reserves of Tomahawks. So it'll be one key test of today's discussions with Zelensky, whether he's willing to give those missiles.
What are we watching for briefly, Tony, in terms of what may come up in these meetings, apart from the Tomahawk question? There was some discussion about even economic relations between Russia and the US.
Yes, that was a theme that the Kremlin noted, that Trump was emphasizing the possibility for really strong relations on the economic field between Russia and the US once this war has ended. It's something that the Kremlin has dangled before. It's clearly something that they see interest in from the US. And again, you know, Zelensky will come to that meeting today with an offer to the US for various kinds of cooperation as well. So it's a much more transactional relationship on both sides of the war.
Okay. Bloomberg editor Tony Halpin, thank you very much indeed for that important update. And we'll watch, of course, all the developments around Zelenskyy's meeting with President Trump later as well. Coming up, we're going to discuss how China's restrictions on rare earths are impacting Europe, including how Europe is able to supply weaponry to Ukraine and what can be done about it as well. We'll get the analysis and the expertise. That's coming up. This is Bloomberg. Good morning. This is Bloomberg Daybreak Europe. Happy Friday. I'm Tom McKenzie in London. These are the stories that set your agenda. Global stocks fall as worries over credit send a gauge of US regional banks plunging more than 6%. The fears outweighing news of tariff relief for the country's autos industry. The US president, meanwhile, set to host Ukraine's Volodymyr Zelenskiy after announcing a second meeting with Vladimir Putin, set to take place within the next fortnight. Plus, BBVA's bid gets the thumbs down. The Spanish bank tie-up with Sabadell is off after shareholders say no. Bloomberg has the first interview with the BBVA chairman later this morning. Let's get to the markets then, and it is risk off across global equities on these concerns about the US banking space and the prospect of some ugliness in the credit markets there. European futures pointing lower by a full 1%. Here in the UK, FTSE 100 look to drop 101 points, back below 9,400. S&P E-minis set for a drop of 0.6% after losses by the end of the close yesterday for US markets. Nasdaq 100 futures pointing low by 167 points. Let's flip the board and have a look cross-asset. Where is that money going then? It's going into treasuries and it's going into gold. The treasury rally continues. You're below 4% on the benchmark 10-year at 394. Yields down almost 3 basis points in the session today, and you've seen a big move into the front end as well. This is the safe haven of choice along with gold right now. Euro dollar at 117. The dollar is not part of that story. It is set for its worst week since July. Dollar is not in favour right now, and the euro is benefiting at 117. Brent is at $60 a barrel, set for 3 straight weeks of declines, down 0.3% on oversupply concerns. And there's gold up 0.7%, once again set for its best week since 2008. So investors are jittery then after a rout in 2 regional banks in the US. Shares in Zions Bancorp and Western Alliance Bancorp tumbling after they said they'd been the victims of fraud. Let's get more from Bloomberg's Valerie Teitel. Val, should we take any comfort from the fact that this was fraud rather than a blow-up in credit? What should we read into this? What's been going on?
Well, let's look into the details here. It was fraud when it came to collateral that a fund was supposed to post. And this is a fund that Zion had lent money to. It was a distressed commercial real estate fund, and the collateral that they posted essentially wasn't good enough for Zion's standard for what they had contracted. So Zion's immediately disclosed a $50 million charge-off related to these loans, and then we heard from Western Alliance. It said that it had made a similar loans to the same borrower. So we know that's not just one regional bank that has some risk to this borrower. It's now 2. The other important fact here is that it is a subsidiary of a California bank trust. So again, this is no ties to the state of California. We know that Tricolor was a bank that extended auto loans not just to California but also to Texas. So these are 2 states that are undergoing a lot of significant change off the back of Trump's immigration policy. So that could be a key focus moving forward. But loan fraud when it came to collateral, essentially that's what the story is here. It did also impact not just the regional banks, but the wider Wall Street banks also were in the red yesterday. So there is some sort of fear that this collateral issue will have broader contagion risks. And of course, this comes after issues with First Brand and Tricolor, which were a heavy interest in this week's banking earnings. Yeah, it has. It's been cockroach credit week, hasn't it? And the spotlight is now being focused. And Jamie Dimon did his part in drawing that focus to this space. On that contagion risk then, where are we in terms of that as a real potential scenario, or are these risks ring-fenced? Well, I think the issue is that we know that regional banks extend a lot of credit to the real economy in the U.S. They extend a lot of credit to businesses, unlike the traditional big Wall Street players who are mostly involved in deal financing and larger things like that. So if we have regional banks retrenching on credit, that could possibly have some knock-on effects to domestic growth in the U.S. The other worry is just what's happening in the market off the back of this. We are seeing, as you mentioned at the top there, a broad risk off in the equity markets. When you look at what's happened in the funding markets, there were just slight signs of some issues with funding yesterday. We had some basis in the front end that widened around 30 basis points, which did show that there were someone out there who needed cash on their balance sheet. It's also impacted the Treasury market. That's really one thing that's that's, aside from gold, that's really, I guess, knocked out of its previous ranges. We've had a big rally in the front end. Those 2-year yields are sinking to lows that we haven't seen all year, frankly. And this is as the market starts to think that this could be something the Fed could have to respond strongly to. Now, you have to weigh this up with the worries over the tech industry, because if you can just look back to what we've been talking about in the last 3 weeks, it's all been about worries in the AI trade. But tech was actually pretty impervious to this yesterday. NVIDIA was still higher, was actually the biggest gainer in the NASDAQ yesterday. So in some ways, perhaps the worries have now gone from a bubble in AI to issues of credit and funding.
Valerie Totel, thank you very much indeed with that important update in terms of some of the risks that we are seeing emerging in the regional US banking space and what it could tell us about the real economy as well. Meanwhile, the EU is considering aggressive new moves to protect European industry from being impacted by Chinese restrictions on rare earths. That certainly ties into the tech story as well that Valerie was mentioning there. The move would force Chinese firms to hand over technology to European companies if they want to operate locally. Benedetta Girardi, strategic analyst for the Hague Centre for Strategic Studies, joins me now. Benedetta, thank you for your time. So on the rare earth restrictions that China is looking to put in place, what is your take in terms of the potential impact of these measures? We know it is one of the key topics being discussed in Washington this week.
Yes. Hi, good morning. Well, I think the new export controls will have inputted from China will have definitely an impact on Europe, and it shouldn't be underestimated just because they are perceived as aimed at the US. With China imposing restrictions, especially on heavy rare earth elements, this means that Europe, AI, advanced manufacturing, and especially defense sectors will be hit harshest. And while this might not mean the complete stopping of exports to Europe in this sense, it will entail for sure delays and licensing issues that might cause ripple effects into Europe's rearming plans, ability to supply Ukraine, as well as generally affecting other industries that are not directly targeted by these exports, like the renewable energy and automotive sectors, which are still reliant on some of these materials for some of their essential components, like magnets, batteries, and turbines. So most definitely the effects on Europe will be heavy, and the restriction not targeted the US alone.
OK, so the effects will be heavy on Europe. There's a short-term response and then the longer-term response. The short-term, are we seeing any evidence of stockpiling in Europe, and how effective could that be? And longer-term, can Europe mitigate this by finding additional supplies of these rare earths or building out their own capacity?
So stockpiling is certainly a possible solution in the short term. However, again, the problem with these export controls is that they allowed for just enough and just-in-time shipments of these materials to Europe, meaning it's difficult to accumulate or stockpile materials for European states. So definitely a valid solution that Europe should look into, but one that's going to be difficult to implement if China continues restricting these exports. And when it comes to long-term solution, of course, diversifying is on the mouth of everyone. It's a term that's very much used in the policymaking community. And it's an opportunity. Europe can definitely diversifying by looking at Australia, Canada, some countries in Africa when it comes to mining. However, the bottleneck here is that dependence on Chinese refining and processing, it's still the biggest obstacle for Europe when all of these countries that are alternative miners still ship their materials to China for being processed. China controls 90% of the world processing capacity when it comes to these rare earth elements that are needed in these components. So in the long term, this is not an easy fix, especially because Europe could even build new refining capacity on the continent. However, that takes years, considering considerable financial investments, and there are also environmental concerns relating to building refining capacity. So definitely not an easy one.
OK, so that's important, isn't it? There's the rare earths themselves and where they're located and who digs them out of the ground, and then there's the processing and refining, and that arguably is where Europe is more vulnerable, even in access to the rare earths themselves. Look, China is putting in place a licensing regime, so you can still apply for a license, but that poses its own challenges, and you've highlighted some national security issues that could be wrapped up in that.
Yes, indeed, very much so, because the new Chinese export control also have a licensing requirement for which European producers applying to get these Chinese products have to disclose sensitive commercial or military even information, such as end users, component specification, and in some cases, even images of drone motors. And of course, in this very fragile balance that we live currently when it comes to security and defense in Europe, this will inevitably result in confidentiality issues that will most likely impact Chinese-European trade.
Benedetta, thank you very much indeed. Really, really important kind of insights and expertise in terms of framing this story for us and the potential dramatic implications then for Europe around the rare earth export restrictions from China. Benedetta Girardi, strategic analyst for the Hague Centre for Strategic Studies. Thank you. Now, Canada's Prime Minister Mark Carney says the US has tremendous leverage over economies, including his own, but he's keen to make sure the significance of Canada to American competitiveness is understood. Carney was speaking on the first edition of the Michelle Hussein Show and also talked about renegotiating the US-Mexico-Canada trade agreement.
We have the best trade deal at the moment. 85% of our trade with the United States is tariff-free. We have the lowest average tariff against of any country with the US. It's 5.5%. So we're in a good position now with two important caveats. One is your question, what's going to happen with the renegotiation of what they call USMCA? And secondly, some key sectors, steel, autos, aluminium, forest products being the main ones. Those issues are quite related. Our view is that the renegotiation, it's not formally a renegotiation, it's a review, but I think we should recognize that in effect there will be a renegotiation of some elements of USMCA because the president has signaled that desire. Our view is that a deliberate process, which has begun now with the consultations, including the United States, will make it increasingly clear that in certain sectors, particularly, the integration of the Canadian and US and Mexican economies is essential to US competitiveness. So in steel, in autos, as two examples, that the linkages are so tight. They're so tight such that the the US content in Canadian finished automobiles is higher than the average US content in American automobiles. So we make America stronger in these sectors, and our strategy is to make sure that that is as well understood as possible.
Well, also speaking to Michelle Hussein, Reform UK's leader, Nigel Farage, taking a tougher stance on Russia in an interview with Bloomberg's The Michelle Hussein Show as well. Farage backed shooting down any Russian jets violating NATO airspace.
So if you were Prime Minister and NATO jets Russian jets entered NATO airspace, where do you stand on that? Do you think they should be?
Got to shoot them down.
No questions. Whatever that does, however much that inflames tensions.
Listen, love, you're trying
Russia needs to be taught a lesson.
Listen, love, you're trying ever so hard. I'm the only person in the world, I think, that stood up in the European Parliament in 2014. And do you know what I said? There will be a war in Ukraine. It's coming. I'm the only person that got it right.
Right. Well, the Michelle Hussein Show debuts today. I was slightly taken aback by the listen love comment there from Nigel Farage. The Michelle Hussein Show debuts today. Her full conversation with Canadian Prime Minister Mark Carney is available right now. And with Nigel Farage next Friday. Search the Michelle Hussein Show wherever you get your podcasts. definitely need to download those. Coming up, we're going to be joined by the CEO and co-founder of nPlan, which promises to de-risk construction projects using AI. This is this is AI at work and having real impacts. That story is next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. nPlan, a British startup that applies AI to the construction industry, has raised $16 million in a Series B funding round using AI to analyze a data set of hundreds of thousands of past construction schedules. nPlan says it identifies risks and predicts delays in projects before they occur. Joining me now is Dev Amratia, the co-founder and CEO of nPlan. Dev, thank you for coming in bright and early. So you're backed by the likes of Chevron and Shell. Your partners include Chevron and Shell, but also Anglian Water, HS2, Network Rail, and your investors include Google Ventures and Chevron and Local Globe. You've raised this additional capital. What are you going to be doing with that money? How is the business developing? What are the priorities?
Two priorities. The first one is we've already done incredibly well here in our home market, the UK. Fantastic place to have started the business. But scale is really coming in North America for us. So we're flying over the pond to do business there. The Infrastructure Act in the United States, which is in full force of deployment of that capital now, is a fantastic opportunity for us. So that's stage one, or phase one. Right in parallel with that is doubling down on our research efforts. We're the world leader in AI for construction, and we intend to stay that way through investing in our research base.
And to be clear, you have your own models that you've built out on your own proprietary data sets.
Correct. Yeah. It's deepened 750,000 projects of performance data, the largest data set anywhere on the planet that we have access to, and we're the only ones with access to it. And it's an incredible data set that teaches us about how projects perform and gives us this incredible color to help us understand how they're likely to perform. Right? It's this predictive nature that is really exciting in AI today.
There's still a lot of people out there looking for kind of real-term impact of AI. You would say you can make the case for that. Where are you seeing real impact and real cost savings for your clients?
The headline number for nPlan is $1.2 billion of savings delivered to our clients to date. We're a tiny company. We're just getting started. So to put that in perspective, let me give you a real example, Tom. There's a top 5 energy company in the planet. We work on one project with them. That one project, they were headed towards a $100 million loss if they stayed on the path they were on. There was tons of risks that our AI was saying, hey, if you stay on this path, you're headed towards a $100 million loss. Turns out we gave them the insights to take them off that path and onto a $50 million gain. Right? That's a $150 million difference. It took an hour to get to that position on one project. That same company is now rolling us out across their entire global fleet of projects. $20 billion of capital will be deployed under nPlan year on year through one organization.
Okay,
multiply that.
That's a good data point. Give us some more data points in terms of the pace of growth that you're seeing. And is the US now a bigger market for you than the UK? And what level of growth are you expecting to notch up this year?
We've consistently been doubling our business. Doubling gets harder and harder as you keep doubling. But I'm fully confident that we're a $100 billion company sitting in front of you today. The rate at which the real market opportunity, we believe, is in North America. That doesn't mean the UK is tapped out. That doesn't mean Asia has no opportunities in it. There are plenty of large spaces that we can play for, the data center market, the energy markets. These are markets that aren't cooling off anytime soon, as you well report.
What are the biggest obstacles to adoption at this point?
The biggest one, and bearing in mind these are dropping as time is passing with the prevalence of AI, but the biggest one has historically been culture. Most people just don't believe that AI systems can predict such complicated things, right? They can't believe that an AI system might know more than the project team, the experts themselves might know. And it's quite hard. Like even I sometimes struggle to believe that. Sorry?
It can be humbling for those project teams.
Humbling, yes. It can be illuminating.
Right, okay. Look, I want to get your view. You co-authored, or you authored the UK's AI review in 2017.
I did.
In your role with the UK government before you moved back into the private sector. What is your take on the hand-wringing around AI bubble risks. What do you think? With your finger on the pulse, are you concerned about all the money that's being put to play, the circularity in some of these big deals in the US? What's your take?
So AI in construction, to start with, my little world, is only just getting started. But you asked a bigger question than that. No, I don't think we're in a bubble. Fortunately, the capital that is being deployed, which is an absolute gobsmacking amount of capital going out into the world to build these data centers and energy for powering the data centers, is a fantastic opportunity for me at nPlan. But as long as value keeps being accrued, and we're demonstrating value, right? Like, we're showing that this isn't just a buzzword, there's real stories of value being delivered. As long as that remains true, and I'm not seeing that tailing off any second now, construction alone is a $12 trillion sector, and I just told you we're just getting started in it. So as long as these things remain true, the underlying foundations of a market to which AI is powering, I think we're okay. And I'm optimistic.
Thank you very much indeed. The optimism's there. Another raise coming through in the priorities as well, the focus on the US market. Dev Amratia, co-founder and CEO of nPlan. Thank you. Now, next week, it is the Bloomberg Tech Summit, meanwhile, here in London, where we'll be examining the future of Europe's tech sovereignty. Among the tech leaders we're going to be speaking to the CEOs of Revolut UK, CoreWeave, Pigment and Helsing. So make sure you tuned in for that event and those conversations. There's plenty more coming up. Stay with us. This is Bloomberg.
Yes, we are concerned about, potential erosion of central bank independence in general. And there is an empirical correlation between higher inflation and lack of or loss of central bank independence. So that is something that we have to take into account in our decision making concerning the euro area and ECB monetary policy and financial stability as well.
The ECB's Olli Rehn. Well, from the ECB to what's happening around the US and this move, particularly aggressive into the front end of the US Treasury curve. Just flagging for you what's been happening in terms of the 2-year and yields down around 25 basis points in the last 30 days. Part of that, of course, is part of this risk-off sentiment and the concerns about what's happening in terms of the broader credit space. But just worth bearing in mind, the 10-year as well is bid, and you're seeing that action again today. Let's flip the board and have a look at gold, which is another safe haven in this environment of concern about deficits and credit risks. You're at levels. We're set for the best week since 2020. I said 2008, but in fact some of the gains today have paired a bit, so we've gone from the best week of since 2008 to the best week since 2020. That could adjust, of course, by the end of the session. But is this a warning, again, in terms of how much risk is out there? The moves into gold, of course, and the more than upside, 6% upside year to date. Let's flip the board and have a look at Bitcoin, because a very different dynamic there. So much for being a safe haven. No, it's not. That seems to be the message from investors, because Bitcoin, having reached 126,000 on October the 6th, is about 13% below that. So is Bitcoin, in fact, more of a canary in the coal mine when it comes to risks rather than a haven? The opening trade is up next. This is Bloomberg.